the new Wall Street Week.
Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci, along with Gary Kaminsky. Who says things slow down in the summer? A used news week for Hillary Clinton escaping charges. We'll have more on that later.
It was also a bumpy week for the stock market. After rebounding from a steep drop when Britain voted to leave the UK, we saw fears of the fallout return to the market this week.
How should investors gear up for what's shaping up to be a volatile summer? In his first interview since leaving Morgan Stanley, we are joined by former Morgan Stanley Wealth Management President Greg Fleming. Greg, welcome to the show.
Thank you, Anthony. Gary?
A lot's happened since you left Morgan Stanley. Let's talk about the Brexit for a second. Do you think that that was a good move for the UK long term?
No, unfortunately for England and for the UK, I think it's not a great move long-term from an economic perspective. And actually, if you pull apart, Anthony, some of the underlying demographics on the voting, you know, you look at 18 to 24-year-olds having voted almost two-thirds to stay, and then, you know, a lot of the elderly people and some of the manufacturing districts voting to leave. I think it shows that in England, and we're having some of this issue in the United States and in other developed economies, we need to do a better job of working with the people who are displaced by globalization, the people who are displaced by technology, getting them retrained and into jobs that they're happy with, which is kind of the backlash that caused...
Is it just retraining, though, Greg, or are there other things? I mean, because I sort of feel like retraining may not be enough in certain circumstances.
Well, you know, the thing about the world that we live in 2016, the global world, the technological innovation, the speed of change, one of the things I like to highlight is the fact that if you look at the developments 50 and 100 years ago, things like the light bulb or the television, how long it took those things to become mainstream in society. From the time that you could go buy a light bulb in a store to half of the United States being lit in their homes was 50
remembers
years.
The candle lit situation.
Oh, here we go.
But it was 50 years from the time the light bulb started to half of American households had it. 4 years from the development of the iPhone to half the people have the iPhone. So it's a world that changes very quickly. We have to make sure that the people who feel like it's not working for them, the people being left behind, don't do things like say it's better for the UK and England long term to be out of Europe, which I don't think is the case.
Greg, let's talk about the Brexit and let's talk about contagion. Anyone who follows your career knows you were at the epicenter in 2008 in what happened. Your history and obviously working with all the major banks as an investment banker. Are we going to see what happened in the UK have a contagion in terms of global markets? That seems to be the fear again this week.
You know, Gary, I wouldn't draw a linear line between Brexit and global market meltdown. And you saw the markets, first of all, there was a run-up before the vote when everybody assumed they were going to vote to stay. And then you gave all that back over a couple of days, and then it rallied, and now it's going the other way. I think what it does from a market standpoint is it injects another thing to worry about. And this is a reasonably large topic, not just the UK and England, but there's questions about the future of the euro and how will Merkel and the Germans respond here, and will there be follow-on, Scotland, other places. So that uncertainty will increase volatility in the marketplace because you've added something else for markets to worry about.
Greg,
but I don't think it's a single line up or down.
Greg, if you look throughout history, fixed exchange rate systems do not last. The euro is effectively a fixed exchange rate system among those 17 nations. And so do you think that it's sustainable long term?
I think it really is going to come down to Germany and what comes out of Merkel and how the Germans respond to this. You know, Anthony, I think from a larger policy perspective, what they've tried to do in Europe over the last 2 decades, given some of the challenges in the 20th century in Europe, is a good thing. And I think pulling markets together, increasing trade, I mean, we have pressure on trade now all over the world. It's in the U.S. election. And by and large, a globalizing world with free trade and free movement of capital and labor, by and large, that's a better thing for humanity. We need to make sure we're dealing with the people who feel that that's not working for them so that we don't end up having countries retract, trade decline, because that's not going to help the global economy over time. So, you know, the short answer is I think it could hold together because, you know, you're dealing with one of the most successful, largest economies in the world in Germany.
Let's talk about interest rates. Some say it's the language of business. You and I have talked about interest rates for probably 15 years together. The headline of this week is negative rates. More rates around the world are now negative. Record lows in terms of the 10-year here in the U.S. What is the bond market telling us that we don't know about what's happening with all the concerns you brought up around the world?
Well, I think a couple things, Gary. One, nominal growth is going to be lower than it was in previous decades. So a fast-growing economy, and this is a big challenge for China, we can get to China, a fast-growing economy will be 4 or 5%. A developed economy like the U.S. will be 1 or 2%, not 8 to 10 and 3 to 4. So growth has been pushed down everywhere. So that's one thing. The second thing is, given the uncertainty and a lot of the challenges that these central banks are dealing with, rates are not going up really anywhere, even here, where I think our Fed has missed the window to take rates up. And I do think that's going to be a problem over time because the economy is now...
When you say missed the window, you think they should have been raising rates earlier? And if so, when?
Well, over the last 12 months, because I think you're now looking at an economy in the 86th month.
Yep.
The underlying business cycle at some point is going to wind down here. It's the second longest expansion on record. Now you've got a strong dollar and all the challenges around the dollar. It's going to be very hard for them to raise from here. I don't think they will. I think they weren't even inclined that way before this. So what will happen? What is the Fed going to do when the economy slows because the business cycle slows at some point over the next year or 2 or 3?
Okay, Fred Fleming, stick around. We'll be right back with more along with Charlie Gasparino. He has some questions for you as well.